report that Ed mentioned talks about the probability of overshooting 3 degrees C by the end of the century. But whether, to a large extent, that probability is determined by what will happen in the next decade, right? Not by what will happen 50 or 70 years from now. And we do need to take action today, tomorrow, and possibly yesterday to bend that curve already in the 2020s and not later on in time.
Welcome back to This Week in Carbon. I'm your host, Eddie Smith, alongside Rene Velasquez. And today we have two amazing guests. We have Vinay Kulkarni from Thryve.earth and Stefano De Clara from International Climate Action Partnership, ICAP. Thank you guys for joining us today. Really appreciate your time. And, we've got some great stories and topics to dive into from this week. But to kick things off, I would love to, introduce you to the audience and just have the audience learn more about you and your background in the space and your work in the industry. So how about we go around the horn and just start off with that? Vinay would love to hear more about it.
Thanks, Ed. And Stefano, I'll try to keep it brief so that we can get on to you soon enough. I've been my first interaction with carbon markets actually began in 2007 and 8, back still in the CDM days. I've had a bit of around-the-clock career. So I worked in carbon markets, then did very large-scale capital projects for a living. And that taught me a whole bunch of things, which I'm quite happy about, which is helping us in our current work. Since then, I worked with Bain & Company, and primarily in the whole agri-food industry or serving large nature organizations as clients. So life came a full circle when, before I moved on and started Thryve about 3.5 years ago, I was actually working at the intersection of capital markets, people who are looking for their carbon decarbonization strategies, and actual nature projects, working with the likes of the large NGOs, right? So the epiphany was I hadn't spent, as an operator, time in this industry for more than a decade, and I had left it for quite some time ago. And what I figured was when I was doing more and more work in this space, it hadn't changed a lot in the last decade and a half that it has been around, at least in my professional journey. So the question or the visceral reaction in my body and heart was, wait, it's a tough nut to crack. I want to leave a reasonable place for not just my children, but hopefully many more human beings and all the other sentient beings on this planet, without having the, what's the right term for this? The audacity to believe that humans can fundamentally alter the course of this planet, but seems like we have, not in the best shape and form, but the planet will bounce back, right? So the question for me was, how can I extend our lifespan for a few more generations till we figure out what more can we do here, right? And the answer came back, hey, you need to get right in and see what you can do to fundamentally alter, right, some of these things. So that's where Thryve came through. And in fact, I have a lot of gratitude for all the wonderful humans in Southeast Asia and beyond who I spoke to in that journey, hundreds of them. And a few people really over-invested, brought me back into the space, helped me understand what's going on, what I could do with my life. But also, I met a few people who I thought I could start working with. And one of them was my co-founder, Ron. And it's been an incredible ride since then. That's me. And now what do we do at Thryve? Look, we essentially are a full stack nature-based project developer. And I deliberately left out the word carbon in that. Right now, we are using the whole carbon markets as an instrument to finance our work and get the journey going. But we genuinely think that the underlying work is the same, whether you do carbon projects or biodiversity projects or water projects. Essentially, you're trying to build or help ecology regenerate, aid it to regenerate faster so that, yeah, like I said, we can have a few more generations on this planet, right? And when I say full stack, and the lines are blurry, right, in the market. So I just want to be very clear. We originate projects, and what does that mean? We speak with actual landowners. It could be smallholders, could be large corporates or individuals who have large tracts of land, where they may not even know there could be a carbon project there for the time being, and figuring it out with them. And then we design the projects. Once you originate, you actually go through the whole journey of technically figuring out what fits, what doesn't, which methodology, among other things. And as we go along, we have to start structuring it to make it an economically viable project. And I think we'll speak quite a bit about that today. In that interaction, you start talking to financiers, off-takers, and whatnot. And we have an in-house function to actually deal with that. And eventually actually do the operations once our projects are up and running in different shapes and forms. So in a nutshell, we do the full stack, right, end to end. That's the what. On the how, we have a few principles which we really take to heart, right? One is we started Thryve not to do one project and retire, right? It's we really want to be the agency through which, hopefully hundreds of projects for the next few decades can manifest. And that needs a different one is execution on the ground and getting stuff going so that you can do a few projects, but also thinking system level, what can I do differently so that, I can repeat this in a different context, in a different setting, in a different environment. So scale is very important for us longer term, which is why we've been investing a lot of time thinking about that first principles from day zero. Second thing is integrity has become a very strong buzzword in the last few years. And I think it's used quite a bit, sometimes loosely. But I think to us, it genuinely means if you do your work with deep care, integrity naturally manifests, right? So integrity is an outcome, and we take care with a lot of pride, and we try to do a lot of that in our work. And the last thing I would say is there's whole carbon markets 1.0, and again, the definitions vary. But in the context of project development, I see a slew of peers who have come up in the last few years, and I'm really very happy and proud that, look, the industry is genuinely moving forward. On the back of the wonderful work that 1.0 developers have done, right? And I think therein comes the whole transparency, provenance, just something which anybody and everybody can think of as a fungible outcome or a product, right? It just makes life easy. If Rene is telling somebody a story about, hey, this project in Indonesia is great, or that project in Colombia is great, any Joe out there in the world or Jane should be able to see and say, okay, I get it. What is similar, what's not. And that's something that we're trying to drive. Technology is a answer, but it's not panacea in and of itself. There are many other things that we need to layer in. Let me stop there. I think I've spoken enough to give context about what we do and how we are operating. Over to you, Stefano.
Thanks, and thank you, Ed and Rene, for having us. It's great, and
pleasure. I count you guys both as friends, and I love the diversity of your backgrounds, and also how there's this kind of commonality around the challenge. And so, Stefano, sorry to interrupt, but I'd love to get your context, and then I've got some interesting anecdotes around how.
No worries. And, I was about to say, so I've also been in the market, broadly speaking, for quite some time. I mean, not as long as Vinay, but a bit over a decade by now. I think, Rene, you and I probably met almost 10 years ago now on a world tour of workshops looking at Corsia, right? Trying to bring airlines up to speed with what they had to do to get into the carbon world. And
sure,
I mean,
it was a fun road trip, let's call it.
Exactly.
We literally, I should put this in the show outro. We had this most amazing road trip after an event in Miami that is still one of my fondest memories. Picture Stefano and I driving a yellow Mustang down from Miami down to the Everglades on a sightseeing day after the conference. It was fabulous.
We should probably say it was also a formative journey. I mean, it wasn't all
it was
fun, but yeah, it was also a lot of building capacity and promoting readiness for airlines on all of this. So it was fun and useful at the same time, for sure. But yeah, so I've been in different parts of the market over time, and in different roles. In my current role, I head up the secretariat of ICAP, the International Carbon Action Partnership. ICAP is a partnership that brings together governments worldwide from different geographies, different continents, and also different levels of governance that get together under ICAP to jointly work on the development and implementation of emission trading systems. So by mandate, we mainly focus on emission trading systems, but obviously we also keep an eye on different parts of the market, trying to understand how the interlinkages work and where the convergence that I guess we'll talk about in a second is coming from. And I mean, as ICAP, we mainly do technical exchanges and technical dialogue work among governments, because they like to have ICAP as a safe space where they can get together and jointly work on understanding challenges and figuring out the way forward for their emission trading system. So we help them understanding what emission trading systems can go next to increase impact and increase resilience as we move towards the net zero. We also do quite a lot of capacity building work and readiness building to basically bring more governments up to speed in their journey to develop new emission trading systems. And we also have a knowledge sharing function where we try to build public knowledge and disseminate data, information, and insights on all things related to ETS design and implementation. Before that, I used to be the director for international policy at ITA, so working a bit more closely on the product sector side, and this is where we met Rene, but also a bit more closely on the whole international market and VCM and market for carbon credit side of things. Again, this is also where some of the where I got some of the interesting insights on where this whole discussion around convergence between voluntary and compliance markets might go next, and what the future might bring us.
Awesome backgrounds. Thanks, guys. Really appreciate that. Sets the scene. Eddie, why don't we kind of bring it back to the kind of stories, and then let's leverage both of our guests' expertise to the advantage of the audience here.
Yeah, certainly. And I think, I'd like to start off with this story, which kind of sets the scene for what we all do, right? And the purpose surrounding our industry. And this is in regard to new research models that show the likelihoods of different climate scenarios. And it shows that 3 degrees centigrade isn't a worst case, it's actually most likely. So I think this is a pressing article that was just released. So up until now, climate scenarios have been treated as narrative pathways without assigned probabilities. So climate scientists have resisted giving scenarios a likelihood because of the deep uncertainty related to political and technological and social factors. But this new paper from the EDHEC Climate Institute challenges that idea that probabilities can't be assigned to climate scenarios and provides 2 robust data-driven methods to it. So the first is an informative method, which starts with an economics view on the social cost of carbon. And the second is a maximum entropy method, which makes as few assumptions as possible using current carbon prices and basic policy constraints as the only inputs. And what's remarkable about both of these approaches is that the results they produce are almost exactly the same, or they're very, very similar. And the model outputs are: the most likely temperature anomaly in 2100 is between 2.8 and 3 degrees Celsius. And there's a 35 to 40% chance of exceeding 3 degrees Celsius. And there's just a 1% chance of staying below 1.5 degrees Celsius. And from other articles I've seen this year, it seems that the world has already breached 1.5 degrees Celsius, being that 2024 was the hottest year on record. So, from the combination of the physical climate risks, these higher temperatures increase the likelihood of triggering irreversible tipping points for which standard damage functions no longer apply, right? And this is a dangerous territory, and it sets the scene for, like I said, why we do what we do and the whole purpose behind, carbon reductions and climate technologies. So with that being said, would love to get your thoughts on this and what you make of this probabilistic shift and how it might influence, policymaking, investment, or market urgency in the future. And if you think, these scenarios are influencing how actors in the carbon markets may assess risk and opportunity. Would love to hear your guys' thoughts overall.
Maybe I can
Who wants
kick
to
us off.
jump in first? Yeah, go for it, Vinay, please.
Yeah, feel free to jump in at any point. Look, I think maybe I'll start off with the whole storytelling a bit, right? Which is, why is it that we haven't seen the level of action that we all hoped we would see? I really love some of our good friends in the space who keep talking the positive stories, the sentiment, which is great. And I think we should do more of that. But I don't know if you guys have heard of this. I don't know the exact scientific name, but there's this whole syndrome where humans and human minds can't perceive change, which is either very gradual or too sudden and melodramatic, right? That's what happened with Titanic or many other examples.
And humans can't think in exponential terms either.
Yeah, precisely.
We think in gradual, linear probabilities.
Yeah.
We don't think in exponential, which is, this is where our minds just don't compute.
Yeah. And I think the movie Don't Look Up, Leo DiCaprio and Jennifer Lawrence.
That was classic.
It's funny, but at the same time, it can be super overwhelming for most people, right? If you get it. Now, from that context, when I think about what's been driving, so first of all, I'm not surprised, Ed, that these results have come out. To answer your question, while I'm a STEM student historically and I'm an engineer by training, I understand it, but I'm not going to get into the mechanics of the models and how they've done that. But if I think about your next question, which is how will this affect policy making or businesses reacting to these things, and that's where the heart of the question is, right? If I just trace back the last 5, 10, 15 years of what's happened in the markets, there have been some pioneers, right? There's always somebody who puts their neck out and says, you know what, this is critical, and let's go after this and solve some major issues. But you've also seen enough noise where there's been a bit of a clawback, without naming any specific organization for that matter. Now you put that in the context of why that's happening. At the end of the day, a lot of these decisions are just forward-looking pattern recognition that needs to happen, comes from what people are solving for on a day-to-day basis. Can I get my voters something that they really care about today? Can I get my board/shareholders what they need tomorrow or the next quarter? And you can't penalize somebody for making those choices, because that's at the end of the day how they're also getting judged or decided upon, right? So in that context, you need some outcomes which people will start realizing, oh my God, it's going to affect me personally. So either people are experiencing these climatic events in and around their personal lives. Like in Bangalore, we've been seeing 100 mm rainfall, right, in the last few years. And in a day, this is massive flood. I'm sure in Singapore has been planning for the 2050, 2060, where there's an act thinking at least to get to can we raise the whole country by 10 meters or 5 meters or whatever the number is. The recent announcement where BlackRock said, you know what, I'm now worried because I think, and there's enough studies out there to talk about this, 50 to 60% of the global GDP is dependent on nature, biodiversity, and all the events that's going to happen. So if 50 to 60 trillion of the global GDP actually is at risk, then it's serious, right? So largest asset managers will have to start taking into account. And it's no surprise that some of the biggest funds out there right now who are actively thinking about investing in this space are backed by large insurance companies, right? You think about the guys at AXA, you think about the guys at Aviva and whoever else. So by virtue of these facts, what you recognize is one needs to understand that this is going to hit my P&L, this is going to hit my balance sheet, this is going to hit my people. That's when the outcomes will start happening. So what my hope I mean, I don't know how quickly this will happen, but what my hope is that people start changing the narrative from I need to solve for carbon credits and carbon as an answer to I need to protect my business interests. And when the correlation starts becoming very evident, I think we'll see a lot of change. And hopefully, within 5 years, I think we've shifted the narrative from 1.5 to 2 to 3 now. And I don't think it's more than 5 years, as far as I can remember. So hopefully this drives a lot more momentum than what we've seen in the last few decades.
Yeah, well said.
Stefano, did you want to comment on this?
Yeah, no, of course. And I mean, I will largely agree with Vinay, especially when it comes to the realization that, it is sobering, obviously, but sadly, it is not surprising. I mean, it confirms the trend that we are, headed for in a way. And it is also, a stark reminder that we're just not doing enough in terms of mitigation. And this also triggers considerations on a few different levels. I mean, first of all, on how we can bend this curve and how we can reduce that probability of overshooting 3 degrees C and bringing the temperature rise down. I mean, one key consideration is that for how difficult it could be and how challenges it could be, we do need to hold on to the Paris Agreement process and to the multilateral nature of the UNFCCC. And it's a tough time to be pushing for that at a time when multilateralism is eroding for a number of reasons. But for example, in a year where we're approaching COP30 in Belém, and when countries are expected to put forward new and more ambitious commitments, most of what we can do in terms of bringing that curve down will need to happen in the next NDC cycle. So again, the extent to which we can make progress at the multilateral level between now and COP30, and to the extent to which countries will be willing to put forward more ambitious commitments will play a significant role in determining where we're headed. Because again, the report that Ed mentioned talks about the probability of overshooting 3 degrees C by the end of the century, but whether, I mean, to a large extent, that probability is determined by what will happen in the next decade, right? Not by what will happen 50 or 70 years from now. And we do need to take action today, tomorrow, and possibly yesterday to bend that curve already in the 2020s and not later on in time. So that is one level. The other one is the other thing that makes me think about is the respective balance between mitigation action and adaptation action. And obviously, the more we fail on the mitigation front, the more costly and the more needed adaptation will be. So again, I don't know if it is in the scope of the report that Ed mentioned, but it could be very, very interesting to see what is the cost associated with overshooting 3 degrees C. And if you factor that cost in, and if you bring that cost forward, I'm pretty sure that a lot of mitigation action that is now too costly to be pursued will suddenly become reachable, just because again the cost of inaction and the cost of not mitigating but having to adapt later will be much bigger, obviously. And then, I mean, more to the point of your question and more looking at what this means for carbon markets and carbon pricing. I mean, first of all, I think again, I mean, it's worth keeping in mind that carbon markets and carbon pricing are a tool to an end, and they need to be fit for purpose, right? So this is also to say that carbon markets and carbon pricing will work differently in a 3 degree scenario as opposed to a 2 degree or 1.5 degree one, in a number of different ways. I mean, for example, think about buffer pools for forestry projects. I mean, what does a 3 degree world mean for buffer pools and for the viability of forestry projects at a more operational level? I mean, what does the overshoot associated with being on a 3 degree trajectory mean for the need for carbon removals in the first, but also in the second half of the century? And the trajectory we will be on will have major implications for what these markets will look like. And back to my adaptation point, and this will be my last consideration in the interest of time, it's worth keeping in mind that both compliance markets, so emission trading systems, but also the market for carbon credit and the voluntary market are markets mainly designed for mitigation, but they can both have also significant adaptation co-benefits, right? And again, if we start to get on a trajectory where adaptation work will need to be much more predominant than mitigation work because we failed at mitigation, these additional attributes and co-benefits will also take an increasingly center stage across compliance, but also crediting markets. But yeah, I'll leave it to that in the interest of time.
No, these are awesome insights. Thank you, guys. So I'm left with the kind of enviable task of trying to piece them all together and kind of provide you guys with my thoughts. So Eddie, I want to come to your question, and then I want to try to go chronologically for what these guys have said. And I try. My memory is not that good, and it's getting late, so I know I will get it wrong in terms of order. But you asked about what do we think about this probabilistic kind of view. Vinay, you talked about insurance companies as part of your comments, right? So insurance companies assign probabilities that use actuarial models and historical data to incorporate what these frequency analyses, severity modeling, catastrophe models, et cetera, in order to then price these premiums and set these reserves. So ultimately, the world prices risk through this type of probabilistic event analysis, right? So it's a really great lens to look at the climate through. Right. And you're right, Stefano, around this kind of dichotomy between the mitigation and then the adaptation. If I can kind of try to weave both of your worlds together, right? And you kind of touched on this, Stefano. So again, clearly I've messed up the order, but you said, you've got compliance markets and you reference ETSs. I want to do a deeper dive with you around the kind of coverage, because it's obviously increasing on an annualized basis. You reference NDCs and the like, but increasingly it seems that there's a kind of momentum for next generation policy measures that are either hybrid tax and crediting, or allowance, or sort of other mechanisms. But there's an inclusion under the Paris Agreement, certainly, in the direction of travel is for these project-based approaches. So the dichotomy or the delineation between project-based approaches used to be only in the domain of voluntary markets is no longer existent. What they both share is essentially they're trying to price this negative externality, right? And Eddie, you and I talk about this on pretty much every week's episode. And by doing that, coming back to what you said earlier, Vinay, is if we can start to look at the world through this probabilistic lens to assign the risks, to then deliver the policies that then help to mitigate this outcome, and then ultimately we can talk about adaptation. And we can start to think differently around, like you said, Vinay, which is I think the most pressing kind of insight around protecting, as asset managers looking to protect their existing assets and leveraging the carbon markets as a way to effectively keep score, as opposed to we're balancing the books in terms of liabilities and the emission avoidance removals therein. So that's that piece. I want to come back to two other key important topics that you guys highlighted through your interventions, which I'll go in reverse order. So adaptation, I want to come back to last, and then like what you said, Stefano, around what does a 3 degree centigrade future look like? Because Eddie, you said, I think in your intro, and I'm just looking through the notes, you said essentially headline findings of the EDHEC Climate Institute, most likely outcome by 2100 is a 2.8 to 3 degrees Celsius outcome. So there's a 35 to 40% chance of exceeding 3 degrees, only 1% chance of staying below 1.5, right? So we've got the Paris Agreement, which is try to get to 1.5, but no more than 2, right? But clearly the data is telling us that on the current trajectory, we're not bending that curve down sufficiently quickly enough to Stefano's point. We need to take action in this critical decade of the 2020s, not in the 2050s, and we need to bend the curve down. But if the probabilistic outcome of exceeding essentially 2 degrees and above, which is essentially a climate catastrophe, is 57% and ultimately 92% above 1.5, we really need to have this sense of urgency, right? And so that's the kind of the context of urgency. But what does a 3-degree centigrade future look like? I read this terrifying book. I don't recommend it. It's absolutely terrifying. It's the doomerism you referenced earlier, Vinay, called "The Heat Will Kill You." But it's brutal, and it's true. Like you reference flooding, right? But heat waves then become much more frequent in a lot of the semi-arid and kind of tropical regions of the world around the equatorial belt, right? And those events that were once rare, like 50 degrees centigrade days, become annual in many of the regions. And then these wet bulb temperatures approach these thresholds that humans just can't survive in certain regions. So then that creates these unintended secondary effects of mass migrations. Right, sea level rises. Right, we're all kind of familiar with that. You get, these tipping points you mentioned, Eddie, in terms of collapse of the West Antarctic and Greenland ice shelves, which are irreversible essentially. And then you get dieback of rainforests, et cetera. So you get these cascade events that then just start to go, and then you get these methane bombs that then explode, which create this feedback loop. Think, Siberia, et cetera. It's not good. And then you got to talk about what you said, Vinay, around the dependency of so much of the world's population is unequally distributed or unevenly distributed, and you get not only the GDP losses, but you get the food and water security crises. So basically, climate catastrophe is what happens under a 3-degree world. It's not great, let alone the economic impact. So we need to act, and we need to act now. And this is the urgency that essentially binds us. This is the common thread that really ties in what we're all doing across the different sides, whether it's compliance markets or voluntary or in projects or in advisory or in trading. The collective we have an opportunity here. So that's that. And then the final piece, and I promise I'll shut up, is the adaptation piece, right? Stefano, you highlighted that. So it's interesting that in the last month, JP Morgan came out with a paper actually talking about unlocking the resilience through strategic climate adaptation. But it's basically guys to say that the big banks recognize that climate adaptation is a huge money-making opportunity for them. Why? Because there's an uneven distribution. So you said it before, Vinay, right? A country, city-state like Singapore, very wealthy city-state, can theoretically and do already have the infrastructure and the capacity and the capital to go ahead and create the resiliency and the climate adaptation. But that is not the case where the rest of the populations lie. Think sub-Saharan Africa. Think India, the subcontinent, right? Bangladesh, et cetera. And you could go on and on and on. And so you get these uneven distributions of the pain felt in these different regions. And those countries, let's not bullshit here, they're not prepared for the adaptation bit. They're ill-prepared for the current kind of mitigation hierarchy, and they've got already inefficiencies right there. If we don't act now in these next 2 decades, they're cooked. And now we have to deal with all of the problems of war, famine, and mass migrations. That's the future that's here, and it's not a pretty one. And so again, urgency. We need to act and do everything everywhere at once. That's my thoughts.
Yeah, no,
Eddie, sorry to leave it so long.
No, I completely agree. And I wanted to briefly jump in on your you made a good point about the food systems, and I just want to say beef prices in the US are at an all-time high, and the levels of cattle are at 70-year lows because of the long-term droughts that have hit the Midwest, right? So I think it impacts commodity prices from an inflation.
There's some untold inputs into that. You've got obviously deforestation, and you've got water that don't get accounted into the costs of that product, right? And nor the carbon impact. And so that's actually underrepresentative of where it's at, but it shows that supply demand constraint, and that's what the elasticity with regards to the pricing. So folks can trade those all day long, and maybe there's a signal there to go long on those futures. But ultimately, if you don't have a supply chain, right, and you don't have that, then you've got food issues, and you can't sustain a population if you've got insufficient calories. And so that's the kind of situation that we've got to all understand. And oftentimes we kind of sit in these ivory towers and we talk about, like you said, integrity and quality and good and bad and the subjectivity, and it's fucking noise. And we just got to get on with the task at hand. And often I like the framing, Vinay. It's like, hey, do you want to protect your asset base? You're an asset manager with fiduciary obligation. You're an insurance company that can no longer write premiums in certain parts of the country in the United States, like California, to protect against wildfires. What are you doing? You got sitting on all this cash, start to deploy it where it can deliver impact, and start to deploy it now. And whilst it may be imperfect, the scale and the demand signal ultimately over time can actually be honed to deliver the best outcomes, to provide that resiliency, protect the biodiversity, and ensure that food security supply and protection of our biome. If we don't, we're literally and figuratively cooked.
Yeah. All right. Well, I think this is a good segue into our next topic.
Shit, if Rich Gilmore was on this one, it would be over, guys.
Yeah. Well, look, I think because we're talking more about the broader macro landscape, I think it would actually be good to go into the ICAP's global emissions trading report for 2025.
Right.
Because, you know, we touched on compliance systems such as emissions trading systems and carbon taxes and hybrid schemes. And overall, that is serving as one of the, you know, broader market-based solutions for the problem that we were just describing, right? So shifting gears to the new, you know, emissions trading worldwide status report, which is a great report, comes out every year. I'm not sure how long it's been going on, but this report continues to highlight the expansion of emissions trading systems and explores how many of these markets are increasingly integrating with carbon offsets and crediting mechanisms. So I believe there's now 37 ETSs in force, which covers more than 40% of global GDP. So it's obvious that carbon pricing is no longer a fringe tool. You know, it's an essential mechanism, right? But the landscape is becoming more complex. And Stefano, you play an immense role in creating this report, and I think it'd be great, you know, given your insights, if you can help unpack the reports and some of the most important trends and regional highlights, maybe some of the implications for market participants, you know, developers and corporates and all the likes. So yeah, that would be great.
More than happy to, thanks. And after the doom and gloom of the introduction, let's look at the positive, because I mean there are positive stories out of this, and a big positive story is that we are, you know, collectively as a global community, we are taking increasing action to bend that curve, and you know. It all starts, as we talked about, with the countries taking commitments to reduce emissions, but then, you know, at the practical level and at the policy level, in many instances, that takes the form of the implementation of compliance carbon pricing policies and emission trading systems specifically. So. And this is also a big part of, you know, the ICAP mandate. Obviously, we monitor this space and we try to, you know, educate the public on where we are at with the ETS implementation. And as you pointed out, we condense all of that once a year in our annual report. And if you look at, you know, where we are with implementation of emission trading systems as of today, we see that we do have 38 emission trading systems in force in, you know, many different continents, with 11 more systems under active development and 9 more under consideration. And this also speaks to, you know, the level of momentum behind the implementation of emission trading systems, but also speaks to the progression that we are likely to further see over the next few years. At the moment, the emission trading systems in force, so those 38 that are operating already, collectively cover around 12 gigatons of CO2 emissions, meaning that, you know, 12 gigatons are effectively, as of today, under an ETS cap. That is, roughly speaking, 23% of the overall global emissions. So, you know, quite not there yet, but also not a negligible share. There was a massive.
Can you repeat that, Stefano? How much percentage is currently under coverage?
23 by ETSs only. If you also count in carbon taxes, looking at compliance carbon pricing more broadly, you will likely add another 4%, roughly speaking.
Yeah, and
So,
Wow.
there's some really great
And obviously,
graphics on
sorry, Eddie.
that would be good to add in, Olaf.
Oh,
So,
yeah. We should put
yeah.
that in the show notes for sure.
I would
For sure.
just to have it like right now if we could. Or
Let's
things
put
are
it
moving, yeah.
let's put it in post production. But can I just dive in? Just obviously, Stefano, having you on as this as the thought leader and expert representing the excellent work that ICAP does, and Eddie, we'll put in the emissions like trading worldwide map that I think you're thinking about. Is it page 21? But I actually want to dive into one thing that I read, which is a great little tidbit. I want to get your insights here. So like the regional developments, you talked about, other emerging economies that are trying to, bring their ETSs tailored to their unique sort of economic and environmental context. I think, it had like Brazil, India, Indonesia, Turkey, Vietnam, etc. But one that's already in operation and is looking towards expansion, which I don't think gets enough coverage, is the Chinese ETS. Can you talk to us around how that system plans to expand its national ETS to include other sectors, right? Like where has it started? Where is it going? Kind of thing. So obviously energy is covered, and then it starts to go to cement, steel, and aluminium sectors, etc. But it's this potential increase of coverage. Like there's a huge potential. We're talking gigatons here, right? In terms of additional potential, which would cover what, an extra 5% or something of global emissions, if I'm not mistaken. Can you unpack that one for me?
Yeah, exactly. I was about to get there actually, because there are a few really interesting stories too that we should unpack. I mean, first of all, on where that came from. This also speaks to the convergers, but also the respective roles and responsibilities of compliance carbon pricing on one side and crediting mechanisms on the other. And I'm saying this because China's journey with the market-based solution started with the CDM, right? And that is what helped building the capacity to then take up compliance carbon pricing over time. And already since 2013, again, building on the previous experience that China had with the CDM, they started to develop regional pilots in different provinces to test out this concept of emission trading systems and see how an ETS could work in a context such as China. So over time, and since 2013, they developed 8 different pilot emission trading systems. And then eventually from 2020, they launched a national emission trading system that, as you pointed out, Rene, initially and for the first 4 years, only covered the power sector and has now just expanded to cover industrial sectors as well. It's a peculiar type of emission trading system. It's quite different from the EU ETS, for example. Other than being power only up until recent, the other characteristic is that it has an intensity-based form of cap, even though China is looking to transition to an absolute cap over time. But that is, again, as you pointed out, Rene, that is a large and quite impactful system. So when it only included the power sector, so up until recent, the overall cap size was 5 gigatons, meaning that again 5 gigatons of emissions were covered, priced, and regulated by one single policy tool. The expansion to industry has brought in an additional 3 gigatons, meaning that now the overall market size is, roughly speaking, 8 gigatons. That is, I believe, just short of 10% of the global greenhouse gas output, meaning that again 1/10 of the global greenhouse gas output is regulated by a single policy under a single cap and subject to a single carbon price, and that is quite remarkable.
Yeah, it absolutely is. And the other thing that's remarkable, I love it. And I'm such a nerd for the infographics because the shout out, like Eddie said, your infographics on this report are like seminal. And it's not just us, but so many other folks that are talking to buyers and investors and others reference this report on an annual basis. So we can continuously kind of geeking out over it. I love, and we'll put in the show notes as well, but like the yearly revenues that are raised by each system are really significant. Because oftentimes people get kind of mired in what's the size of the market? And the markets collectively, because like you said, there's different policy tools, there's hybrid systems, there's allowance trading systems, there's taxes, and there's project-based systems that are starting to emerge now, even on mass, and will further unlock under the PACA and the Paris Agreement crediting mechanism. But it's really astonishing. Like most folks, I think it's fair to say, understand that the big game in town is the EU ETS, right? And so you're talking, what is it? I can't remember what's the size of the EU ETS on a revenue basis?
Billions. I mean, in terms of gigatons, it's roughly 1.2, 1.3. In terms of revenues, I think it's north of 40 billion a year.
40 billion. These are the revenues going to the governments, right? Yeah. And then there's a trading sizes of these markets as well. Yes. So like the trading size of the EU ETS is like over 800. It's 800 billion, right? In terms of market cap. So it's huge potential, right? And then you've got these slivers of markets, even old guys like me who've been in this space for a long time, just don't even see. Like it says Austria here has raised, $1.2 billion in revenues in 25. It's crazy. So I would really encourage people to do a deep dive and have a look at this analysis. And then the other cool thing that you've got, and I want to shout it out, is you got fact sheets on each individual country. Like, not sure if people know, but Ukraine has a system. Obviously, you've got Reggie and a bunch of other states, but Mexico, Dominican Republic. You've got a bunch of really cool ones, and you've got it segregated essentially by region. So you've got Europe, Central Asia, North America, Latin America, Caribbean, Asia Pacific, and we start to see this distribution of global coverage. It's really fascinating to see the evolution in particular. And we also love the map. So we'll put all of those graphics in the show notes.
Thanks. And
I just want to say one thing, which is a little bit of a fanboy moment for me as well. I mean, as much as I'm right brain all hard, but I'm also very left brain when it comes to digesting information. So Stefano and team, I think hats off to you guys for putting this off every single year and just upping the ante every time.
Thank you. I just want to,
I wonder how many McKinsey and Bain slide decks have sourced and attributed graphics from this report and the World Bank report. No comments.
We should charge royalties. No, I just wanted to point out a couple of things. I mean, practically speaking, things are moving so fast in the ETS space that, for example, the report that we published just 2 months ago is already out of date because it is not including, as you pointed out, Rene, the expansion of the Chinese ETS. So we are now working on a quick update to, again, update our statistics and data, which will come out in a few weeks. So keep an eye out for that one. I also wanted to fully paint the picture of where we're going with the ETS implementation. I wanted to come back to your point about regional distribution of ETSs, because we are in a period of remarkable growth. I mean, both the global coverage of emission trading systems, but also the pure number of ETSs in force has more than doubled over the last decade. And I mean, there's a huge momentum behind the implementation of these systems. And especially in recent years, and you touched on this, Rene, already, but most of this momentum and also most of the prospects for further growth are coming not from the developed world, but from emerging economies and developing countries. Again, we touched on China, but Indonesia and Mexico have also launched emission trading systems recently. India, Vietnam, Brazil, Chile, Turkey are all at different stages of ETS development and implementation. And these key and large emerging economies are likely going to be at the forefront of the next generation of emission trading systems. And if you look at G20 countries, for example, ETS is already, the ones that are already in place as of today cover more than 25% of the G20 overall emissions. And again, if we, between now and 2030, if we fast forward and we have ETSs in place in India, Turkey, Brazil, Japan, the EU ETS 2 will also come in force between now and 2030. together with, again, the expansion of the Chinese ETS, that will mean that ETSs only are expected to cover more than 40% of the G20 overall emissions. And again, that speaks volumes as to what potential these tools have to, put a price on emissions first, but obviously also start quickly reducing those emissions to bend the curve that we were talking about at the beginning of the show.
Yeah.
That's fascinating. Can I give one final kind of comment on this? But it's this: as you start to get broader and broader coverage and distribution of these various systems, you start to get interoperability, right? And this is kind of like the genius of the Paris Agreement, right? Whether it's 6.4, but in particular 6.2. And I'd love to get your thoughts on this, which is something that I've been thinking about for a while, and I've been discussing with some other carbon nerds. But obviously, you've got folks like, or country folks, but member states like, Switzerland and Singapore that are playing these kind of leadership roles, right? Establishing these bilateral agreements under Article 6.2. It would seem to me that given China's outsized weight with regards to their own emissions system, right, and the broad coverage that they now have, that they're essentially short with supply of CCERs in domestic country, and that they have another lever that they haven't yet pulled, right, which is to extend their diplomacy through Article 6.2 and then have these bilateral agreements connectivity through the Belt and Road Initiative. So I'm just going to postulate like a hypothesis here. What happens if, as you start to get broader and broader distribution, the number 2 by GDP economy of the world, one of the superpowers in the world, which is causing this geopolitical tension, starts to now take a much more active role in creating essentially linkages, bridges between other countries to enable the trading from, like you said, the global south into China. That sends a huge demand signal, right? Which then enables and begets the investment piece. So am I on the right track? Is this kind of something that you see as a potential, or is this kind of flight of fancy?
No, I think you're spot on. And again, this starts to get into the interoperability of different types of carbon pricing policies, and also the convergence topic that we talked about at the start. And I think, as you pointed out, there's a lot of potential there, but at the moment, it is to some extent largely untapped. And let me unpack that. What I mean is that compliance, emission trading systems, and also carbon taxes can be a key source of demand for carbon credits, right? And as you pointed out, Rene, there are benefits to that. There are also potential challenges and things to be aware of, but there are also significant benefits all the way from extending the reach of the carbon price, because you effectively, extend here the reach of the carbon price outside of your covered sectors. You can, stimulate demand for carbon credits. You can use your ETS as a source of climate finance effectively, because covered entities have an incentive to finance mitigation projects. And you can also, as you pointed out, stimulate and pursue interoperability between different systems to the extent to which they mutually recognized similar crediting protocols. So, it's promising. And if you look at the state of play, again, you will find this into the latest status report infographics. We do have many different emission trading systems that, as of today, allow for the use of carbon credits as a possible compliance option. And out of the 38 emission trading systems that are in place as of today, 24, so the majority of it, does allow for the use of carbon credits. So what's the catch? First of all, most of that demand is purely domestic at the moment. With the exception of the Korean ETS, all other ETSs only allow for the use of domestic credits. That might change now that we have, full Article 6 operationalization after Baku. But up until now, again, most of that demand was domestic only. And it's also worth keeping in mind that there is a difference between the potential theoretical demand coming out from these systems and the real situation on the ground. And what I mean is that if you simply do the math and a back of the envelope calculation, seeing what the offset, the maximum quota of offsets allowed looks like in different systems, and you multiply that by the cap size, you get a massive volume of demand. I mean, north of 1 billion carbon credits a year. But the reality on the ground is different, and there are limits to that. Again, from the outset, most of that demand is purely domestic and it's not international yet. And also low prices and significant levels of free allocation in some of the existing systems are also muting that demand. But things might change as prices go up over time and as systems might become more ambitious. And as a last quick consideration, because we spoke about China before, I think it will be quite interesting to see what this convergence between credit mechanisms and domestic emission trading systems will play out, especially in China. As you pointed out, the CCR can easily be seen as also an international crediting mechanism in a similar way as the JCM is for Japan today. And again, let's keep in mind that because of the size of the Chinese market, the demand for carbon credit out of that market can be big. Again, as of today, in the Chinese ETS, covered entities can meet up to 5% of their compliance obligation through CCR credits. And 5% of a 5 billion cap means, roughly speaking, 250 million credits a year. 5% of an 8 billion cap, so post expansion to the industrial sectors, means 400 million a year. And we all know how that compares with the current level of retirements in the voluntary market, for example. And again, I think it will be quite interesting to look at how this will evolve going forward.
Yeah.
Yeah.
Vinay,
I'm not going to continue to interrupt because I could talk about this all day long with Stefano, but I want to include back Vinay in the conversation.
No, I had a specific on this topic, and this is not my insight. I do want to share it because I was in London last week, and I was fortunate to meet Benedict from Restoration Climate, right? And he talked about this, and full credit to him, by the way. Maybe we should mention that as well for this specific comment. He said, look, we're all carbon long, naturally, we're in this industry. But something that's changing in the last few years with the whole ICVCM and CCP label and the Article 6, everything coming together. And to Stefano's numbers, and I mean, I'm not going to get into the numbers, he really understands that and the size of it. But from the context of the market, there are these critical points where it's like a locomotive, right? You touch the smallest place where with a single tip of your finger, you can stop the locomotive. In the markets, it's the regulations. So if you can solve for that, then everything will fall into place. I mean, people like us who are developing projects will be more than grateful for amazing regulations and the interoperability between the two. But something that Benedict said, which was, since the emergence of these so ICVCM, CCP labels, etc., what's changed for governments? Let's say they've been thinking about this for a while. I mean, at least the pioneering governments who are backing the space. But what's changed is from thinking about, hey, here are 30 standards, 100 plus methodologies. How do I make it fungible for my corporates who want to buy into or exit or whatnot? To saying, you know what, this is Article 6 compliant and it has CCP label. The underlying standard, the underlying methodology, I'm not saying they couldn't care less, but they don't need to worry about it. It's essentially switching the conversation from here are the 25 parameters in the oil or the coal or the nickel that you're buying to here is Brent, it trades at X, and tomorrow it's going to be at Y forward, right? It's that simple. So the moment that fungibility comes in, the markets it's already here and it's only going to increase from here. So to Stefano's point, everything he said, just amplify that by an order of magnitude when the voluntary and the compliance is getting together. And I think hopefully we all get to have a party going forward and doing some cool work.
Yeah.
Yeah, and hopefully we can achieve speed and scale. Those are the two most critical things, Vinay, because bending that curve is not happening quickly enough, and it's certainly not happening at scale. Maybe Eddie,
Yeah.
that's a kind of a good pivot for you, or your next story on the doc.
Yeah. Vinay, you mentioned the ICVCM and the CCP approvals. There's a timely, story related to that I think would be good to pivot to. And thank you, Stefano, for describing, the report and all the global carbon pricing mechanisms that are in place in the state of play. I think like the voluntary and compliance convergence is one of the, biggest topics in the industry. You hear it at every conference, and it's kind of where everyone is long on in the industry. So it's good to talk about it. And also, I just think it's really fascinating to see, like, at the government level, how they're talking about implementing the offsets and crediting mechanisms into their compliance obligations for companies that fall under the scope. Like seeing that, and then seeing more in for example, the SBTI, companies that fall out of the scope of compliance systems, let's say in consumer goods or in luxury brands, or just, like we're seeing the government level kind of debate about it. And then at more of a, at the SBTI level with corporates debating about how to implement offsets into their, net zero targets. So it's that level of, okay, governments and then corporates. I think it's super interesting. But shifting gears to the supply side with the ICVCM's latest CCP approvals, they announced the approval of 3 versions of gold standards technologies and practices to displace decentralized thermal energy consumption methodology under its core carbon principle framework. So this marks a significant move for developers eager to have their credits labeled as CCP compliant, a signal increasingly demanded by major buyers and corporate procurement frameworks. So, however, with the broader supply implications still unfolding, the ICVCM has now reviewed methodologies covering roughly 45% of the market's credit volume, with around only 4% of all historical issuances currently qualifying for CCP labels. But despite this, the ICVCM suggests that the supply gap is temporary, and a new generation of methodologies designed with CCP compliance in mind is expected to begin delivering by 2026. And this decision underscores the market's transition away from outdated crediting approaches, but raises questions around near-term supply and buyer confidence and the pace of standardization. So I think, obviously we're seeing the market kind of recalibrate, and specifically on the supply side, like we see that the market looks a lot different in different subsectors, right? Like it's a very fragmented market with, supply on one side. There's a lot of success with this subsector ecosystem, right? And then on another side, it's been very difficult, and there's been a lot of struggle for developers, right? So I think, it'd be great to dive into this and hear your take on the recent ICVCM decision and the ICVCM's CCP tags overall, and the supply of the market and how it's recalibrating for the future, right? Because we're seeing this emerge as kind of the quality standard, right? The CCP tags are commanding premiums in pricing, and giving the buyers more trust, right? Because ultimately, it shouldn't be like, if a buyer buys carbon offsets from the quality standard and registry, it shouldn't be on them to if something happens to the project, because there should be enough trust in the system that the registries and standards have already made sure everything is up to quality, up to par, right? It's the same thing in other in equity markets or fixed income markets or any other commodity markets. I think that's something we touched on last time, but I find that super, an interesting point with the VCM. But yeah, would love to hear your guys' thoughts on the CCP tags and ICVCM overall.
Can I jump on this one? Can we change the order and go 3, then back to the 2, and then the 1? Just joking. It's a Shaquille O'Neal reference for anyone who watches inside the NBA. But look, I think the direction of travel is the right direction. I think I applaud the ICVCM for what they're doing. They're basically the regulator for this market. right? They're creating a level playing field by assessing programs first level, right? And now it's inclusive. And shout out to our friend Thibault Sauret and Judith Simon from the Ecosystem Restoration Center, who we had on a couple of episodes ago. And they just got approved, right? Now you've got, and I think it's up to 7 programs that have now been approved. And that's great. And then if you look at their website, they've got a number of other programs that have submitted and who've now, been effectively acknowledged, and now will then have to go through to the approval stages. And the ICVCM is doing a really efficient job, an effective job of screening these programs on their credibility to create essentially a broad suite of certification bodies that can deliver those outcomes. So that's great. And then they go one step further, which is at the methodology level. So they've got a long list of methodologies that have been approved and have also been rejected. That binary outcome, I don't think is talked about often enough. It's not just a positive list, but there's a negative list. That, to your point, Eddie, around essentially there will be some stranded assets in carbon, and it is what it is, right? There are methodologies that are either old and are not up to par or are failing with regards to not meeting the core carbon principles. Could be additionality, could be concerns about permanence, it could be other ones of the CCPs. So they're doing a good job, and there's people that are going to complain, and you're never going to make it. So I think we want to shout them out. I think what's inevitable is that they create a direction of travel and a signal, essentially this North Star around where new methodologies need to be built, where there's insufficient coverage, where there are opportunities to go up that marginal abatement cost curve. And to your point, now that this regulator has emerged, you can start getting regulatory capture. It makes it easier for governments that are implementing their systems. And we've been talking about ETSs, but there's also these tax and hybrid crediting systems, right? Like Colombia or Singapore, that are also emerging, that are not sort of, we didn't discuss too much, but they allow for the fungibility of these credits. And fungibility is the word of the day here, right? Carbon credits then become fungible across borders and can become tradable as the commodity. So now we start to have different price signals, something from Japan at a different price, something from China at a different price, something in Singapore at a different price. And now project developers, like in any active market, can go to from the farm gate effectively to go and sell their wares to the highest buyer. And I think that's fabulous. And so eventually you start getting that regulator distributing that signal to regulators at the government level, and you start getting regulatory capture, makes it much more robust. And now we have much more investability, and then asset managers and investors can start to underwrite these projects. So great. Kudos. And again, shout out to Thibault and Judith and their team for recognition. It's timely. And we hope that, Sir Carbono and Puro and others start to follow suit in the next intake.
But Rene, Eddie, I feel like there's a part of the puzzle that gets missed often. I think it was last New York Climate Week when I was introducing ourselves as an NBS developer and whatnot. Somebody said, "Oh, but now the conversation is moving to 100-year permanence. How can you assure 100-year permanence if you're doing a smallholder project or even a large landholder project, right?" To ground this in reality, like we are doing a very large scale project in the concept of, in the context of a smallholder project in Indonesia, in Sulawesi. And we consider it very high quality. We are in some of the final stages with some of the bigger RFPs that's going on out there. In that context, when somebody asks me, how can you assure 100-year permanence? How can the document hold up if you sign something with the landowner or the local partner and whatnot? My answer to that is, to your point about stranded assets, right? Which is, you will have surprises. You may have a concept today, and with all the best of intentions, you solve for it, you build it, you work with everybody around, and you put in systems, but you cannot pinpoint and say 17 years from now, whatever plans I've laid out today is exactly what's going to happen there. What you need is a high quality organization with good intent, with the integrity, with the governance processes, systems, to make sure that they carry forward all of that. Like, that's the world order of business, which is, in any corporate world, I mean, you will have M&A. Somebody's buying somebody else, somebody's fixing something else. A specific value chain is going down, a specific value chain is coming up, you're pivoting and whatnot. At the end of the day, as humans, we need to make sure that we are solving for all those things. So in the context of ICVCM and CCP, what I want to avoid, at least in my conversations with people, is for people to think, hey, this is it. This is the the gospel, right? And we're going to just take this and run with it. No, do expect that even the existing methodologies may get whatever is CCP labeled. 5 years from now, we have gotten much better. So the direction of travel fundamentally is, are we getting better or not? And do the project teams, or be it, let's say, the regulators or governance systems, are they all capable, and are they building the capacity to keep adjusting to the market? Eddie, the number you gave, like whatever 90+% is of historical credits are not currently qualified. I'm sure those teams are right now working to figure out how can they bring some of that into the funnel, right? None of them are going to sit idle. So that's my thesis, right? So we should be very proud and happy that these things are moving forward in the right direction, but it's not the end. It's an evolving story, and we all need to be prepared to be participants in those stories.
Yeah, and
I like that view.
Yeah,
I think I just wanted to jump in here. Like, I do think, because you fall under the nature-based solutions side, I think that conversation and discussion and the overall purpose of these those projects looks a lot different than some of the projects that have the CCP tag. So I think, like, for a reforestation project, for people to argue about
the
permanence,
adipic acid projects that were just approved.
yeah, exactly. And it's it's just when I went to the smallholder farmers in Kenya, they're like, we need to be incentivized not to cut down our trees, right? And that conversation is just a lot different, because that's, it's about the deforestation aspect and about the climate mitigation, and it's so I do think the conversations that people are having really look so different, like depending on which side of the market you're coming from, like whether it's if nature-based or engineered removals or reductions. I think that's a really interesting perspective. And on this topic,
Can I just give one point on that? Because like you referenced like other asset classes, right? You talked about equities and fixed income and stuff. People have opinions and they invest in different areas. Like, let them have it. Let the market decide where they want to allocate capital. Some folks want really high returns and they invest in biotechnology and other really, like difficult and kind of, type of companies, right? Others invest in like fixed income and just do a classic, government bond, and it's a very kind of like stable asset class. There's going to be distribution in this market. There's going to be winners and there's going to be losers. Let the market grow and evolve, like Vinay said, right? Like, it's just going to be the case. And we just got to put our emotions to the side and just be objective. What we want is increased coverage, increased participation, increased fungibility, and increase in prices and distribution. And now let the markets go and like let the fun begin.
Yeah. But I would say, there needs to be that viable like financing piece, right? And this is where I want to get into the nature-based story that I read on Carbon Pulse, right? And the investors explained how ARR projects need to achieve carbon credit sales at a price nearly 10 times higher than current market value to make it worthy return on financing. And he outlined the costs faced by developers of these nature-based carbon removal projects, saying that fundamentally, when you're thinking about your additionality benchmark pricing, in order for ARR to really work, you've got to be looking at a price of almost $90 to $100 a ton at a bare minimum, also taking into account the revised methodologies. And this is in part due to, the country taking, 30% of the gross revenues of the credit sales, but also the total CapEx costs for the activity development itself. So, and for context, Allied Offsets has an index for the project type ARR, and that's under just $10 a ton as of the end of last week. So, I think the supply and demand sides obviously need to start talking to each other more, but would love to get your take on this.
It's very interesting you asked this specific question on this call, because I was in the room when that happened. I think the Sea Carbon conference in London, and carbon. Yeah. And Matthew McLuckie, who's the person who said this, full kudos to him for actually coming out and articulating in shape and form, right? So I'm sure that they're working with a project in the region in Tanzania where this is happening. So look, my point of view here is it's all about context, right? That he made can be completely taken out of context, and people start making up stories like, oh, this is not viable, I can't fund this and whatnot. They are operating in a region with perhaps high costs. Maybe let me not use their example, but if you think about the bigger picture, right? Or for your audience who will understand this a bit better, and I'm hoping that non-carbon market participants start seeing a lot more of your episodes, because that's where the journey should go. But imagine you're selling Red Bull at a concert, right? The price won't be the same as what you'll probably buy at a supermarket. So
I love that.
Yeah, I mean, it's going to be 5x, right? Now,
Supply
we've
demand,
been doing.
baby.
Sorry?
Supply demand, baby.
We are operating in Indonesia and India. We were beginning to do some work in Brazil, and we realized that operating out of Asia, we are probably best suited to solve for problem statements here. And we have since sort of decided to actually start working with somebody else there who can take it over and move the project forward. And the context is this, because I deeply understand the cost structure here, right? I've led most of my life here. I understand what it takes to a specific timber species. What does it cost to grow, right? I know how much is labor. I know how much is a truck, what the fuel is going to be to move from point A to point B, and might add other things. Second is, what carbon curves are you getting for your saplings and the growth rates? You operate in a temperate climate, very different story from what you will get in a tropical climate, from a subtropical climate. Like, every latitude makes a huge difference, right? So I think Pachama and the other folks a few years ago put out this $80 number from the context of Latin America. Makes sense. I presume that Matthew, whenever he's done, I mean, they've done their work and they're articulating this in the context of Tanzania. Perhaps makes sense. I'm not here to judge those numbers, but that's very important, right? And the median numbers that you see in allied offsets or anywhere else for that matter, there are many benchmarks out there. You will always see a super wide range, and that's very important. Now, there are different investors, there are different off-takers. For somebody who probably has a value chain in Tanzania, they really want to buy credits and or invest in projects in Tanzania to give back to society, or to our earlier point, which is ensure their value chains from a resilience standpoint for long term, be it mitigation or adaptation. Somebody who buys their packaging from Vietnam for their mobile phones may want to invest in Vietnam or Indonesia. I mean, so it's really. And then lies in, okay, I can afford this price and I think it makes sense. And the numbers will be very different across the board. So that's to just give you a sense of the cost structures, right? One shouldn't take that as a gospel truth and say across the world, this is the number. Having said that, I think part of what Matthew talks about is legit, which is also legit. I think the other part is also legit in their context, which is there is an increase in costs that developers are seeing. Now, the one caveat here, which I feel is important to notice, is if a developer has started a project with extremely high standards in mind, right? Fully grounded in our project is going to be the best in class that the world can offer, you would have already baked in all those costs. So whereas some inflations that people are experiencing from methodologies, dynamic baselining, what does that even mean? It means that, okay, earlier I would have thought about measuring, monitoring future growth rates and whatnot, or even local context in my project area. But now dynamic baselining, it naturally means that I need to look outside my project area and reference area and see what's happening there. That naturally means either I send more people out to check and balance things, or I deploy more remote sensing technologies, or it's essentially those are the two things, right? So naturally, your denominator where you're multiplying your costs, that expands. But if you as a developer have said, you know what, I need to be robust about what my number of credits are coming out, and I want to be super conservative and do it really thoughtfully, you would have already baked it in, right? So I can't pinpoint a number and say, you know what, the delta is 2% or 10% or 100%. I don't think the number is that large because of the additionality requirements, new requirements that have come through in the methodologies. It's probably in the lower numbers, right? So that anybody should be willing to pay and invest into. I hope that sort of gives you a context about the projects.
Yeah, I like that context. And Stefano, jump in at any point in time if you want. I know this is kind of outside of your area of expertise. Maybe dusting off your old AIDA hat. But if you'll indulge me, so yeah, actually, funnily enough, my literally the call before this podcast was with Matt. It was very, very funny that you picked this story. I wasn't at the conference, but so I don't want to comment on specifically that price, but we're working right now with a client helping to bring to market, and we'll make an announcement over the next few days or weeks around opening up their data room for access, large ARR pipeline in East Africa and also in New Zealand. And when you look at trying to create these forward pricing models, any estimate is going to be wrong. We know this from when we launched the geo and the NGO contracts at CBL. We came up with what we thought would be a reasonable forward curve based on a sort of analysis, and you have certain assumptions in those models. And then when you've ultimately launched the contract, the market will find the level. And when we saw that, not only at the spot, but we did that with CME, we provided them the curves. And then ultimately, as the open interest started to build across that forward curve, right, you started to see the curve steepen or flatten, depending on the market. In this case, these actually steepened quite significantly. There's a really nice contango trade to be had. That's why you want to float it. So what we need is essentially price discovery in this market. To your point, Vinay and Eddie, you referenced the allied offset pricing. I mean, we talked to Lisa Street, who's one of my favorite people and her team over at Opus the other day. And they've got really great assessment. Shout out to them as a price reporting agency. We talk to other price reporting agencies and other analytics firms that do great work, Clear Blue, Quantum Commodity, S&P, MSCI, and others. And what they all struggle with is that there's insufficient data for them to do their assessments. And they have the robust assessment protocols and methodologies in order to provide that guidance. But if they're not seeing the data, they're not able to assess. And so no wonder you have these big spreads. ARR in 2025 to 28 is somewhere between $15 to $35 with a midpoint of 25, just, kind of looking at where Opus had kind of their last peg. And that's great. But what does it look like in 29, 30, 31, 32, 33, 34? Does it ramp at a continuous rate? Does it go exponential, hyperbolic? Well, what's the kind of direction of travel? No one's going to know until we actually have the instruments that allow for that trading and for that price discovery to be had. And so what we need now is to harness more of that innovation again and challenge, my peers and old friends at Expansive and other exchanges, CIX and others to actually start to create those next instruments and provide that price discovery, because that's going to be really critical in order to do that. What do I think around pricing? I'd love to see that Matt was right around these kind of prices. The reality is, and you highlighted it, Vinay, is that ARR projects, and then blue carbon in particular, are also really expensive. Why? Because there's a delay between the actual implementation phase and the actual yield. It's not like you plant, you sow, and then you reap immediately. There's a lag. There's quite a long lag. So investors need to be patient. The project developers need to be patient, and obviously there's a financing gap that's at play here. And you're talking about slow issuance at the beginning, and then starting to ramp up in years 7, 8, 9, 10 kind of thing, and then an issuance period over 20, 30 years, maybe in that kind of range. So high upfront costs, and then these issues. It creates this dichotomy around which projects are investable and bankable. And this is kind of a call to action finally to the folks that can actually help to move the needle on this. If you are concerned about securing supply in the 2030s, you need to be taking action today or yesterday, to quote Stefano in a previous comment that you made. In order to secure that supply, you need to be structuring these offtakes on a de-risk transaction, potentially delivery versus payment. And then financiers then can come and take that paper to say, oh, you got a Microsoft, you've got a Boeing, you've got a Volkswagen, you've got a credit-worthy counterparty who's essentially underwriting this project. And if that's essential. So we need all of those elements, and then the price discovery piece around the futures contract. So it's great. So I'll shut up. Stefano, I think you have to drop. So thanks again for your time. I know we're probably way over in time. I just wanted to thank you guys both for participating today.
Yeah.
Thank you, Stefano. See you.
No, thank you guys for the super interesting discussion, and I'm looking forward to continuing it. So whenever whenever you want us back, more than happy.
Yeah, we'd love to have you back. Yeah, I'll put in the outro some of our photos from our travels, Stefano. We'll definitely drop in all the infographics. So again, thanks again, Eddie. Back to you, man.
Maybe I'll welcome you all to our project in Indonesia and India. So do come. I can assure you we'll have an amazing road trip to get to them and have some fun.
That would be amazing.
Let's do it, man. I introduced you to Olaf, right? So he's an up and coming filmmaker. Let's get the crew, the Carbon Exposure crew down there to actually document it. I'd love to tag along. That'd be amazing. Like I said it a number of times. Anytime that you go to a project site visit, you see the reality on the ground, you forever change. And now, as folks trying to commercialize these units, you actually have the real connectivity in the heart to be able to sell this with conviction. And it's really, really impactful. And for folks that can't actually get to the projects, the next best thing is to tell the story. That's something that we're trying to do with the Carbon Exposure project, is to tell those stories. So stay tuned. Do some fun stuff. And Vinay, hopefully we get you guys as clients. Shameless plug. All right, ciao, Stefano.
That said, yeah, thank you guys for
see you guys
your time. And
thanks, Vinay. I really appreciate you.
Of course, pleasure. Thanks, Stefano. Cheers, guys.
Yeah, thank you. This was really great. Thank you. Enjoy your evening, Rene, and your morning, Ed, and your early evening, I guess, Vinay.
Yeah, almost there.
Yeah, enjoy dinner, man.
Thank you. Bye.
Bye.
See you guys.
yeah.
Eddie, back to you. Do you want a shameless plug, a follow, like, and subscribe?
Yeah, I guess, to the audience, thanks for tuning in to This Week in Carbon, and be sure to follow the show and share it with someone interested in climate space and carbon markets, and we'll catch you next week. Until then, keep questioning, keep moving the needle. So yeah.
Thank you. And thanks to our audience. It's also a growing audience. I was just checking the numbers. We're approaching 1,000 followers on This Week in Carbon. We're at episode 15 or something. It's great. If just to folks that are actually listening, really appreciate you guys, and please distribute it more and widely. Like Vinay, I want to echo something you said, right? We don't just want the carbon conscious and carbon kind of pros listening to this. Like I had a chat today with a very young man who said, he finds these really informative. He's been in this space only for a few months, and now he's like, oh, I'm learning so much on the job, but also through the dissemination of these experts like yourself and Stefano. And so we want that, but we also want to challenge thought leaders, folks that are on the buy side. They need to be listening to this to get these valuable insights, right? Folks on the financing side, we want you guys we want to hear your voices. We want to see you guys help to underwrite and invest in these projects, but we want to distribute it. So just my call to action would be, anybody that's listening, if you guys could help to distribute this to some friends and recommend it as a valuable podcast, please do that.